I would like to bring up for a minute or two Nikki Dickerson from First Financial Bank. First Financial is sponsoring our month of breakfasts this month. And we really appreciate not only their support of the chamber, but just who they are in the community and wonderful personal touches you bring. So thank you, Nikki, for being here.
Wow. Good morning, you guys. Again, I'm Nikki from First Financial Northwest Bank. I am the business banking manager. I cover Edmonds, Kirkland, and Mill Creek. We are one of the few community banks that still offer free checking, free business online banking, free remote deposit. We even order and pay for your checks. Most banks don't do that anymore. But we feel like the personal touch is what our business community needs. You don't want to be with a bank that nickels and dimes you, and we have a firm belief that we are not going to nickel and dime our customers. So if you are getting nickel and dimed, or you look at your statement and you're like, what is that fee for? Give myself a call. Another community banker in the room, Jeff King, another awesome guy. He may have the same things we offer, but I'm just way nicer than Jeff is. You know, I love to hear about the new members here. And so when we came to the Edmonds community in March of 2016, I started at branch number 3 for First Financial Northwest Bank. In that time, we are now up to 15 branches. But I came here with a bank that no one had ever heard of, even though we had been around since 1923. And the chamber was absolutely essential to us having the success that we've had. So I'm so happy to see you guys that are joining. Make sure that you are present. Come to as many events as you can. Volunteer when you can, because it is so important and it will absolutely help your business grow. So thank you guys for being here. Thank you, Chamber. And I hope to see you out and about in the community. Thanks so much.
Thank you. Thank you.
Fundraiser sponsor.
All right, so today we are going to hear from Jane Stone with U.S. Bank Home Mortgage. Jane has worked in financial services for over 10 years, specifically in consumer banking and lending. Currently, she works as mortgage and loan officer for U.S. Bank. Her diverse experience in the banking industry and extensive training in the mortgage industry allows her to help better assist home buyers and homeowners in viewing their mortgages as part of their long-term financial strategy. As she often says to her clients, mortgage is more than just a debt. It can be an investment tool to build wealth. So please join me in welcoming Jane Stone.
I have to use a mic just because I'm generally soft-spoken, so and it's very early in the morning. Well, thank you so much for having me and for being here. I'm a new member. I actually just started being a member this. I'm sorry, I'm just looking for the remote.
Oh, that's her.
Yeah, the clicker.
Keep talking. I'll find it.
Oh yeah,
Here it is. She joined in December.
I just joined in December, but I've lived here in Edmonds since I moved to the US, and it's been great. Essentially, I grew up in this neighborhood, and I found out that US Bank doesn't sponsor the Edmonds Chamber, or like not involved at all in the community. So I was just like, oh, why not? Like, let's just join in. I'm a mortgage loan officer, so I don't do any of the deposits and checking and all that. So usually mortgage loan officers, they're kind of like a business owner where we just contribute, and then we basically partner with the bank to offer services. So let's get started. This is me. I mean, the picture is pretty good because like they usually, when you work at a bank, you have to have a nice picture because they keep it for like 20 years. So by the time I'm like probably 50, it would be the same picture. But one of the reasons that I ended up in US Bank, I actually am, I'm more of a community bank person. So it came from a credit union, but I needed a bank that's ethical and offers a lot of services national banks usually do. I can basically originate in all 50 states. So I have a lot of clients who are sometimes here and then sometimes in Arizona or California, wherever it's sunny. So that's usually what my clientele is. And we're one of the largest mortgage lender. We're fifth largest in the country. And basically we're known to have a really good diversity in our employee diversity. It's actually one of the banks that I'm kind of surprised with because it's very flexible and it has like a community feel to it where if I need something, I can just go directly to my manager or my manager's boss and see like, hey, is this something that we can do and all of that. It's a very open communication kind of setup that they have. We have a lot of suite of programs, which I mentioned before. We have fixed rates, FHA, which a lot of lenders do. We have a lot of jumbo mortgages right now in a rate increasing environment. Our portfolio programs are actually doing very well. Like it's much lower than regular fixed or ARM loans in other places. We also do interest only and construction to permanent loans, which is a huge product to have that right now. We do lot loans, condo, and then we have precision loans. It's specifically for people who just graduated medical school and then starting residency in a hospital. It's the reason that we have those is because sometimes their income is lower when they start. So that's basically why we offer that. Anyway, this is actually going to be the meat of my presentation just because I wanted to talk about the current mortgage and real estate market, which is a very hot topic right now. No one knows what's going on. It's very uncertain. And all of the things that I'm going to be going over is just basically an assessment that I have based on different reliable sources, such as the Federal Reserve, the National Association of Realtors, Freddie Mac, Fortune, Time Magazine, all of that. I usually read the news almost on a daily basis just because it's changing a lot. First topic is just the mortgage rate pricing this year. We essentially started beginning of the year around the low threes. That's an average, but now we're actually, it says in there that we're in a 4.5-ish, but this morning we're probably in the 5.5 on an average. So that's just an average. You might be able to see something between, low fives, but it depends. It just really depends on you, your factors that you have, but we're currently right there. And honestly, like when we started the year, a lot of experts actually predicted that the rates are going to be about 4.5 by the end of the year, but everyone who had predicted something actually had to basically erase everything and restructure what their current projections are. It's an insane market. Despite of the increasing rate, though, we still think that the real estate market's going to be hot. In fact, the rates might have been just a double-edged sword because there's a lot of buyer demands right now, and the fact that the rates are increasing, it may decrease the demand a little bit more. So basically, what the demand of the housing market is basically what it's doing is that it's increasing the prices of the home. So with the rates, it may lead to a more balanced market. And it doesn't necessarily mean that the appreciation of homes would go down, but what it would mean is that it wouldn't increase as much as it did in the last couple of years. So right now, one of the reasons that the housing market will likely stay hot is just because a lot of the millennials and Gen Zs are still buying homes. They make up about 31% of home buyers. And it's not that they're killing the market, it's just that they're at the age where you usually buy a house. And this is a good quote with Realtor.com, the Realtor.com's chief economist. We expect a whirlwind in 2020 for the housing market. Home sales are expected to still rise for another 6.6%. And the home prices to rise another 2.9% on top of the 2021 highs. Other affordability challenges will come from rising prices and mortgage rates. rising rents, which are projected to increase 7.1, very strong, motivated for many hopeful first-time home buyers. So the home prices are going up as well as the rent. So a lot of people would rather buy a house than rent. So that will still be a motivator for people who are buying a home. As we're talking about the inventory, the reason the housing market will likely stay hot is because of the demand. We don't have a lot of supply right now. So I pulled up this chart where it shows from 1999 all the way to 2021. So as you can see, we don't have a lot of supply. And that's the main reason why there's not a lot of home sales. So if you see something in the news where home sales are down, it's not because the bubble is bursting. It's just because there's not a lot of inventory to sell right now. So we just can't sell what we don't have. And this is just a more in-depth view of what the last year and a half-ish looks like. So in January 2021, we were already in a very low inventory market. We literally hit the lowest in February. And then in the last 6 months, it finally increased a little bit. So that's the market that we're working with right now as far as supply and demand. And then just going a little bit further, this is the buyer traffic index. And they took this from National Association of Realtors. This is the bluer it is. I don't think you can see how blue it is, but the darker it is, the stronger the buyer demand is. And this is where the seller traffic index is. So if you compare the two, it's not balanced at all. So it's a very tough market for buyers right now, especially with the rising interest rate. Just the affordability of it is definitely going to hit some low income people. So if you're not the type of person who has if you don't have a lot of debts and you're relatively making enough money and you have a little bit of down payment, then you might be able to, still win some offers. But we're hoping that the market will be balanced by June. Because of the rise in interest rates, and hopefully there's more homes in the market. And then this is just a chart to show how many homes are being built since the 1970s all the way to 2020. And we're literally below the 50-year average. So, if you look at 2010, just after 2008, which is right here, because of 2008, builders usually encounter a lot of roadblocks as far as financing. A lot of them have been overexposed after 2008. So new built homes experience a lot of more regulation, and most banks try not to take too much risk with builders who are overexposed just because of 2008. One of the reasons that I think that this market is very different from 2008 is because the lending standards have been very tight since the crash. So it's not, it's not different. It's not going to likely be a crash because of irresponsible lending practices. It's going to be, if there's any crashes at all, it's not going to be based from that. It's going to be outside factors. I pulled up this chart from Keeping Current Matters of all the loans that are below 620. So as you can see, before 2008, it's way high, and we're literally right there. So theoretically, a lot of people get a mortgage have a good credit score. And then this is also just a chart that shows all the distressed properties and foreclosures and short sales. We are really, really low. I actually just saw an article that says that foreclosures went up 7%, but when they say that, it's usually 7% of less than 1%. So it's unlikely that we'll get a lot more foreclosures. And then on top of that, a lot of lenders now, especially the last few years, are more flexible as far as like helping people with repayment, like, mortgage forbearance or loan restructuring. So that's one of the factors that there's not going to be a lot of foreclosures that, people are usually afraid of. And this is just like these are all the experts that predicts what the home price forecast is for 2022. And they still think that we're gonna be, at an average of 6.7% increase on the home prices. It used to be higher in the last two, all the projections in the past couple of years have been high. But right now, I think that it's going to be less than, it was gonna be a little bit less than the past 2 years. Well, hopefully so, just because, I know a lot of first-time home buyers and they really cannot afford to do any appraisal gaps or anything like that. And then there's just another look of the price appreciation that's in the rating. So as you can see, in 2021, it was like 10%, and then all the way to like 17%. And then now it's just gonna be a little bit tapered off. It's not gonna be too drastic of an increase. There's another good reason to like purchase a home is that even if you purchase a home right now, you could still gain equity. You're not really, there's no data around yet that says that home prices or home values will go down. And then here's another topic that I think most people don't know is that home equities are a good hedge against inflation, because basically, if you think about it, a lot of people that I actually know here in Edmonds have owned their homes since, I don't know, 1960s or 70s, and they bought their homes at 36,000 or something like 80,000. And then now, if they still own that home, that's likely about $1 million, so like 800,000. So as inflation grows, your equity grows as well. So if you're looking for a good place to put your money in, is still real estate is still a good investment to have. And then just to end it all, what should home buyers and homeowners do to take advantage of the current market? It is a difficult market. A lot of people, I think, could see that, but I would just say, just be patient, reassess your priorities, maybe like balance out what your wants and needs if you're looking for a home. If you're a homeowner, this is a great time to take advantage of your equity. So if you have a lot of debts, basically just to consolidate your debts using your home's equity, or like if you want to do home improvements, or you want to move up to a better home, this is still a good time to do that if you're a homeowner. If you're in the middle of the home buying process, what I would do too is to stay connected with your mortgage professional. The rates are constantly changing, so you could be approved for a certain amount right now, but a week from now, if the rates increase, then you might not be approved anymore. So it's just like, or you could still be approved, but it's just the cost that you have will be higher. And remain educated and up to date with the process would be a good thing as well. Your real estate agent or your mortgage professional should be able to keep you up to date with the questions you have. And my number one tip is always ask questions. It's never, like if something doesn't make sense to you, it's a big purchase, so just ask away. They should be, like if you're working with a mortgage professional, you should be able to answer all of those. And then, just going back to where I work for US Bank. If you need help, you can always come to me. And the number one reason that you can come to me or to our company for any advice is that we're named one of the ethical companies in the country for 7th year in a row. And then, we value quality and service. We do all of our mortgage, like if you go through our home financing process, we always send out surveys to make sure that you are satisfied with our service. And then those surveys actually get back to us and see what we can improve with the process. And just to make sure that we're giving you the, you're basically just, we want to make sure that you're supporting you throughout the process. And then we have a dedicated team. I have, so for me, I usually work by myself. I have 4 branches that I cover, which is Edmonds, Linwood, Shoreline, and the Alderwood branch as well. So you might not see me all the time here at Edmonds, but usually I take in appointments if you're in the Edmonds area. Or, and then we have like a nice team over there. I work with the branch managers. It's kind of like, you know, our team kind of acts like a community bank just because of the way we're structured. We're structured regionally. And then I think this is it. We just for our clients, we offer a discount on the closing costs as well. So about a 40% of whatever the loan amount is, up to $1,000 towards the closing cost. And yeah, thank you so much for having me, and then let me know if you have any questions. I usually ask them if they, you know, if they where they're at in the process, that they look at their finances, or what do they know about like home buying, you know, if they have any questions, because you know a lot of people are in different steps of the process. They either like they have thought about preparing their credit or their income, or they have not. So we usually start with that.
Yeah, it's been a long time since I was in that process, but you still look at income to debt ratio, minimum FICOs, that sort of.
Yes, because like
What is it?
it depends on the lender. With US Bank it's 620. We're kind of conservative in a way that way. We've always been since even before the crash. It's just we're more adverse to risk. So
Is there a benchmark on your debt, income to debt ratio?
it's the same as any lenders. We're at less than, if it's a conventional loan, then it's gonna be below 49%. You gotta be at 49%. BA and FHA might be a little different because they do residual incomes. So you could go above 50%, but generally, ideally, you want to be below 49%.
Now, does the bank sell their loans once they leave?
We do, but we keep the servicing. So like anytime you make a payment, you still ask that you will contact.
So, you know, the home buyer would send the mortgage payment to you, even though, and then you would send it on the debt holder.
Yeah, we handle, so basically it depends on the mortgage program you're in. Any type of conventional mortgages are often sold similar to like any other lenders. FHA and VA is the same way, but it's sold to like the FHA and then the VA. But with portfolio loans, those are the only things that we kind of keep, I think. So some of them, but if you're making a payment, any questions with escrow, we keep all of the servicing so you don't have to, you know, because the hardest part is like when you're a first time home buyer or like if you're a homeowner is if you go through a broker and then they sold off your loan, now you have to transfer all of your automatic payments to that new lender. And then they could do that as many times as they want, which is the hardest part. And then, yeah, so that's why we decided to just, you know, service all the loans that we originally.
I know it kind of bypasses your process, but with Canada putting a 2-year moratorium on foreign home purchases, you think some of the, you know, that market, the Chinese buying homes in Canada is going to shift down to our area and keep the market a little bit tight? They're coming in to buying all cash to kind of stick their money somewhere.
From what I've seen, I don't really see any data of it. We do have a cash problem because everybody has a lot of equity on their home. So for example, I have a few clients who have a lot of equity on their house. So what they would do is they would just sell all of that, right? And then they'll have this huge amount of cash where they will just offer cash on a new house that they want to buy. And then there's a way that you can get your money back doing that too, is just you do a delayed financing or like a cash out refinance right after you sell the house. So you don't have to go through the financing process during the time you're trying to close on the new home. But yeah, that's one of the things that, that is kind of like, that's Canada. With the US, it's actually kind of hard to get financing for any foreign nationals. You have to go through a specified lender to do it. We don't do them. I am aware of the different international banks that does them, and their rates are higher.
Generally, the foreign purchase is just straight cash.
Yeah.
It's really to house it somewhere, stick it into an asset. But I know that, the last couple months, I've seen some houses in my neighborhood that went listed for 1.2 and went for 1.675, closed in 2 weeks.
That's been happening.
And it was a foreign buyer. So just looking at, there's still a lot of money overseas looking for a place to hide.
And on top of that too is another thing is like after 2008, the government allowed LLCs to own residential homes just to be able to artificially increase the prices of homes. So that's another thing that home buyers potentially have to compete against, is all the hedge funds that are buying up residential homes. I work for a bank. A lot of people think that I'm part of that team, but I'm part of the first-time home buyer teams because I don't get paid unless I get somebody to a house. So I always had to explain that, in my own opinion, not this bank's opinion, but to me, I think as soon as our economy had recovered, that should have been limited. Like the LLCs buying up residential homes, just because, there's a lot of people who want to buy a house. And, if we're really passionate about people being able to build wealth through real estate and own their first home, then we should be prioritizing owner-occupied properties. I mean, you can even do like investment properties for those who are like trying to build a retirement, like retirement income. But it's just right now, it's kind of hard just because there's so much money in the market and there's so much cash in the market. So the rates increasing, it's kind of like, there's going to be less demand, but a lot of people who are, not able to afford a home might be kicked off of the market.
So I think we've all heard how some buyers are offering 20,000, 50,000, 100,000 or more over their selling price. I mean, that just seems so hard for, like a first-time home buyer to get into a house. What is like the average people are paying over or offering over selling price? Is it 20,000? Is it 100,000?
It's usually, I have not seen the data on what's the average appraisal gap is. But from what I've seen is that your real estate agent is really like a great partner to go about this, because you could tell them that, hey, I can't afford that. So, the paying over the price is fine. Because it's like right now with the data that we have, like the value of that house could go up anyways in like the next year or two to that price point that you already paid for. But I still see buyers, like I have a few clients that still been able to get their offers accepted, even with 3% to 5% down. This just has a lot to do with strategy. You kind of have to strategize with your real estate agent and your mortgage loan officer. How we're going to do this? For me, a lot of the reasons, like I have a few clients that have their offer accepted, but that's because when the usually listing agents, number one concern is that, is this going to close on time? And is this deal going to go through? So if we can convince them, give them confidence that, hey, we will close on the closing date that you want, that might sway them to accept the offer of those first-time home buyers. It's money. It's still money. For example, like between somebody who's paying cash and somebody who has financing, and it's the same offer, it's still the same money for the sellers. So, and then sometimes in a lot of ways too, it might work better for the seller to pick someone with the financing, because oftentimes they need a little bit of time to move. So, that might work well with them. So it just really, like, this is the part where your real estate agent's negotiation skills will be put to work. So, I've had a few agents who are really, really good at doing that. The fact that like a few of them had 3 to 5% down payment, and their offer got accepted is kind of like, that speaks volumes to like the negotiation skills of that agent. And I'm just there to support them. I mean, I don't really do the negotiation, but I'll call the listing agent and let them know that, hey, we verified all of these and we're sure that it's gonna go through.
Do you think that what's going on in your brain is gonna affect us
Yes,
in the housing market?
it still does. It was actually a concern. It's actually a concern with the real estate market. It will, in a way that, like as we've seen, like the rates are increasing. So that's how it's affecting it. It's basically with bond rates going up. So that's what I've seen. And I don't think that it would. I mean, at least I have not read more on how it affects the real estate market. But in the grand scheme of things, including like the stock market and the bond market, it just puts in another level of uncertainty with the way everything is going. And it's already been uncertain in the last 2 years since COVID happened. So it's almost like you cannot predict what's going to happen in a week or in the next few months or in a year.
Thank you so much, Jane.